Like platform sandals and polka dots, something old becomes new again in the reporting for discontinued operations. In its humble beginnings in 1973's APB 30, a discontinued operation was a disposal that resulted from a change in business strategy and represented a major line of business. Last month, the FASB issued ASU 2014-08 that redefines a discontinued operation as a disposal that represents a strategic shift and has a major impact on an entity's operations and financial results. So while there was a detour along the way when the FASB issued Statement 144 in 2001, discontinued operations is returning to its roots with a model really intended just to capture those disposals that have a significant effect on the ongoing operations of the entity. I'm Angie Storm. I'm a partner in KPMG's Department of Professional Practice and in our real estate industry group. And with me today is Daniel Imperial, a senior manager, also in our national office, who's been working with me on discontinued operations. So with that, Daniel, why don't we go into why did the FASB revise their guidance on discontinued operations?
The FASB began this project as a joint project with the ISB in 2008. The objective of this project was to develop an improved definition of discontinued operations that also enhances conversions between U.S. GAAP and IFRS. Some stakeholders expressed concern that too many disposals, including small groups of assets that were recurring in nature, qualified for discontinued operations. That resulted in less decision-maker useful information. Additionally, some of the guidance resulted in higher cost for preparers because it could be complex and difficult to apply. By revising this criteria, the FASB believes these concerns were addressed. The changes also enhances convergence between U.S. GAAP and IFRS. Part of the new definition of discontinued operations is based on the definition of discontinued operations in IFRS 5, which indicates that a discontinued operation should represent a major line of business or geographic area of operation.
Yeah, and certainly, although the definitions are similar now between U.S. GAAP and IFRS, there are still some differences. U.S. GAAP is based on component of an entity, IFRS is a cash-generating unit, but maybe more significantly, the new guidance in U.S. GAAP is based on a strategic shift sort of principle, whereas in IFRS, they've got kind of a definition that says a discontinued operation is a disposal of a major geographic area or major line of business. So there may be some differences that remain under IFRS, but certainly we've gotten a lot closer. So Daniel, let's go ahead and get into the details. Can we just talk about what the new definition is?
The new definition, you could meet it in two ways. First, if you're a component of an entity or a group of components that meets certain criteria. Specifically, if you've been disposed of, meets the criteria to be held for sale, or has been abandoned, or more importantly, and where more judgment is involved, if it represents a strategic shift that has or will have a major effect on operations. You could be a discontinued operations if you meet those criteria, or if you're a business or not-for-profit activity that, on acquisition, meets the criteria to be classified as held for sale. And that second one was an item which was previously outside the scope of discontinued operations, which was now in the scope of discontinued operations.
So the definition is really written in a very principles-based way in that it's trying to identify only disposals that are strategic shifts and that have a major effect on operations or financial results. So it's definitely subjective, given the emphasis on the shift needing to be strategic. So there'll be a sort of a tendency to try to understand how that disposal group fits in or maybe doesn't fit in to how the company's historically described its strategy, how it views its business, and sort of directionally where it's going. Major impact on operations also is sort of an undefined term, so there'll be some judgment around whether a particular disposal is or isn't major. There is no sort of bright lines in the standard around what major necessarily means in all facts and circumstances. So with that, Danielle, maybe we can talk a little bit about any changes there are to financial statement presentation and disclosure.
From an income statement perspective, there is no change as a result of the new guidance. A gain or loss would be recognized on the disposal, is presented on the income statement separately as part of discontinued operations. and a gain or loss on disposals that do not represent discontinued operations are reported as part of income from continuing operations. However, from a balance sheet perspective, there would be a change, or there may be a change for current GAAP. Previously, under U.S. GAAP did not specify whether an entity should reclassify the assets and liabilities of a discontinued operation classified as held for sale in the balance sheet. Therefore, practice developed. Generally, people didn't reclassify prior periods, but some entities did. The ASU requires that assets and liabilities of discontinued operations be separately presented in the current year as well as for all prior periods. However, if the discontinued operations never met the held for sale classification criteria, only the prior periods would be presented separately.
And I think it is important to note that while the balance sheet needs to be recast into prior periods for a discontinued operation, there's no changes to those disposal groups that are just held for sale and not discontinued operations. The guidance there is still that they need to be separately presented as held for sale assets and liabilities for the current year, the year in which they meet held for sale, but there's still no requirement to go back to prior periods if it's not a discontinued operation. So let's just talk a little bit about the disclosure requirements. Danielle, can you just briefly talk through those?
Sure. The FASB has expanded the disclosures about discontinued operations because they felt users needed more information about the assets, liabilities, revenue, expenses of the discontinued operations. And those disclosures are pretty detailed and complex. And then for equity method investments that meet the criteria for held for sale, in certain instances, an entity would be required to disclose summarized information about those assets and liabilities.
Great. I think there's also some additional disclosures about individually significant components that get disposed of that are not discontinued operations. So there's a bunch of disclosures, and there's actually some pretty detailed flow charts in the standard itself to kind of walk through the disclosure requirements. So maybe we'll briefly touch on effective date and transition.
Sure. The ASU is effective prospectively for new disposals on or after December 15, 2014. There's a little difference between non-public and public. So the key thing is that early adoption is permitted, but you cannot retrospectively apply it for any disposals before, certain periods.
Right. So I think the thing to keep in mind on transition is that it's very much event driven. So in whatever period you adopt the new ASU, from that period forward, all classifications and held for sale classifications would be under the new standard, but anything that had been disposed of in a prior period or classified as held for sale in a prior period in financial statements issued, those would continue to be accounted for under the old standard. So with that, we're going to wrap up. It brings us to a close. If you want more information, we do have a webcast available on replay on FRN with some more information as well as our defining issues on discontinued operations. Thanks for listening.